Hello, this is Caroline Bell from Summerhill Financial Services, just with another update. This one's specifically for the recent budget. There's three main areas that I just wanted to touch on that's sort of most relevant, I believe. One is superannuation, particularly in relation to contributions. The second one is just some minor tax adjustments, and the third one is in relation to pensions. So firstly, with superannuation, what these changes are really sort of about is trying to stop people from accumulating wealth in the tax concessional environment of superannuation that are really not using the monies for retirement, but essentially just passing money on to the next generation. So the first, or the most important, I believe, change is the change in the pre-tax superannuation contribution rules. So at the moment, depending on if you're over 50 or under 50, you can put in either $30,000 per year or $35,000 per year. From 1 July 2017, that's changing to $25,000 for everyone, regardless of your age. Now, what that essentially means is anyone that can afford to do so, we definitely recommend that you maximise your superannuation contributions for both this financial year up to 30 June 2016 and then next financial year as well, 30 June 2017, as these changes, if they go through and are legislated, won't be effective until 1 July 2017. There will be some strategies that I look at for more people now with the lower amount that we can put into superannuation. For some clients, we've been using investment bonds. I'll probably start using investment bonds for more clients as a way of sort of building wealth outside of superannuation, given the lower amounts that possibly might be able to go into super. The other change is this cap on the amount that you can put into superannuation after tax. Now, this is a pretty big one because that cap applies of $500,000. That goes all the way back to 1 July 2007. So at this point in time, no one should be putting money into superannuation now from the 3rd of May on an after-tax basis. We'll need to go through and do some calculations for anyone that's thinking about it before anything's done. I should just sort of mention as well, just in relation to that 25,000 pre-tax cap, that if your superannuation balance is less than 500,000, you can actually carry forward that $25,000 limit. But that's something that I'll speak to you individually about if it applies to you. Something that applies to just a few people is this work test. So if you're over 65, you've had to sort of work 40 hours in a 30-day period in order to contribute to superannuation. That's no longer going to apply, but again, potentially not until 1 July 2017. And the last thing just on super contributions is at the moment it's an either or situation as to whether you have employer contributions or you claim a tax deduction for personal contributions. That either or situation is going to be removed, but again, not until 1 July 2017. A couple of minor tax adjustments. At the moment, anyone earning over $300,000 is paying an extra 15% tax on their superannuation contributions. That's going to change to $250,000. So it's just going to apply to more people. The 2% deficit levy that many people have been paying for the last couple of years will be removed from 1 July 2017, so still another couple of years to go. And there will be a small tax cut as well. And lastly, just on pensions, a couple of major changes there. So there was a lot of discussion before the budget about will transition to retirement pensions be stopped completely. They haven't, it's just the tax exemption that will stop being applied to transition to retirement pensions from 1 July 2017. But for anyone who has one of those pensions, that's something we'll go through together closer to the time. And of course, it depends if any of this legislation goes through. A big change, again, that's just been put out there but it's not legislated, is no one can have more than $1.6 million in their pension fund from 1 July 2017. And that's going to apply to every pension fund. So if someone has more than $1.6 million in a pension fund after or from 1 July 2017, they're going to have to move some of that money back into superannuation mode, or actually just take it out of their pension fund. It's another benefit for superannuation splitting along the way. But again, that's a bit of a wait and see. We'll see if this legislation actually goes through. And something else that's a bit of a wait and see is just some innovations such as tax-free benefits that will apply to other retirement income products, not just pensions. And that's in anticipation of many people retiring over the next few years. This is a very broad outline. I've got a little bit more detail in terms of text in this email as well. But naturally, as we have our planning meetings, if any of these changes affect you, we'll be going through those in your planning meetings. But of course, the other thing to remember is none of this is legislated as yet. It's all proposed, so it's very much a wait and see what actually gets through Parliament. As always, if you have any questions, just let me know. I'll speak to you soon. Bye-bye.